Welcome to Summit Investment Advisors Mid-Year Market Outlook webinar. My name is Sean McDermott. I'm the president of Summit Investment Advisors. I'm grateful you're spending part of your day with us. I'm also joined by partners in my firm who are certified financial planners, Brian Carlson, Scott Caskey, and Russell Rogers with us today. We're going to have a 30-minute presentation for you today, followed by roughly 15 minutes of questions and answers that we'll go through. And we'll do our best at the end to answer those for you. The slide deck that I have and I'll be going through is provided by Fidelity Investment. So if you'd like a copy emailed to you afterward, just let us know. So with that said, it's been a strong year for the stock market in 2026 with the S&P 500 up more than 10% for the year and up over 26% for the last 12 months. Returns have been great, and we remain long-term bullish on the American economy, and we're going to go through several reasons why we feel that today. So at the same time, we know markets can sometimes feel a little bit uncertain. So our goal is to give you some perspective, context, and some practical guidance for how to think about the road ahead. So with that as a backdrop, I'm going to move into a screen share mode here and walk you through our 5 key themes. So the first theme is productivity, the AI renaissance. So we're projecting close to $1 trillion to be invested into the AI build-out in the next few years. This is creating an investment and economic boom around artificial intelligence that is just beginning to ripple positively through our economy. So we think over time, AI can help businesses become more efficient and improve profitability. Our second theme is monetary and fiscal stimulus policy as a growth catalyst. So we're seeing some early signs of the One Big Beautiful Tax Bill passed last summer. Our firm, Summit Tax and Advisory Services, prepares hundreds of tax returns for our clients. And we've been seeing many of our senior clients receiving meaningful refunds of $1,000 to $3,000 because of the increased deductions. And when people are getting this money back, oftentimes it's spent back into the economy or invested back into the economy. So that's a catalyst to keep things growing. Now, the tax bill also has a lot of incentives for corporations to invest in capital improvements. Now, those investments and incentives encourage new factories, jobs, and additional investments here into the United States. So kind of tied into that area, unemployment right now is 4.3%, which we see is very healthy because people are earning, spending, and contributing back into the economy, and that also supports corporate profits. Our third theme is economic acceleration and what Fidelity calls the wealth effect whiplash. And what this means is households over the last 2 years have been absorbing negative wealth shocks. We've had higher interest rates, higher gas prices, and elevated inflation. So today we're starting to see a dip in the oil prices, and that'll help bring inflation down. And in addition, we have a new chairman of the Federal Reserve, Kevin Warsh, and I believe he's going to eventually lower interest rates. So if we have lower interest rates, that can really help the housing market by making homes more affordable and encouraging more activity. So housing has a powerful ripple effect across our economy. When people move to a different home, they oftentimes have to buy new furniture, new appliances, televisions, landscaping, and many home improvement products. So that could be benefit home builders and retailers such as Home Depot, Lowe's, and many workers tied to the housing industry. So in other words, lower interest rates could be another catalyst for broader economic growth. Our fourth theme is diversification, spreading risk amid equity market concentration. So a simple way to think about diversification in a concentrated market, it's like playing golf with a full bag of clubs instead of only a driver. So when the course changes, you want to have the right club available for the shot in front of you. Now, our fifth theme is selectivity. As dispersion increases, so should investor precision. And we remain long-term bullish investors, but that doesn't mean that every company in every sector will perform in the same way. We believe it's important to look down the road 3 to 5 years and focus on how corporations may perform in a consumer-driven global economy. So kind of the bottom line is what we think is that you should lean into growth. especially artificial intelligence. We should make sure your portfolios are broadened out so they're aligned with potential acceleration and growth. And then, of course, maintain lower volatility defensive positions in case the market does experience a correction. Now, speaking of volatility, it's an unavoidable part of investing in the stock market. So many firms frequently predict a 10% correction as if it would be unusual, but historically, corrections are part of investing for higher returns. So if we go back to 1950, the stock market has delivered an average annual historical return of 11%, but that doesn't come in a straight line. So on average, there's three 5% corrections in the investment markets every year. There's one 10% correction per year. And we've already seen that in 2026 when the Iranian war broke out. There's one 15% correction about every 3 years. And we actually saw that in 2025 when the tariffs were announced the first quarter. And then there's one 20% correction about every 5 years. And we haven't seen a 20% correction since the COVID period. So when you look at S&P 500 batting average, 75% of the years since 1950, the stock market has had positive returns, and that's a pretty good batting average in order to produce 11% historical rate of return. So now one of the best ways that we think you can reduce your market volatility or weather the market volatility is by having a bucket method of investing. And in general, we recommend that clients keep shorter term income needs, spending needs in a bucket of money that has cash, money market funds, CDs, short term bonds, fixed annuities. So if we do have those corrections in the market, well, you have these other buckets that you can go, okay, well, I can ride this out because I have my short term needs covered. Now, this is a mid-year election year, and historically, mid-year election years can bring volatility to the stock market. So going all the way back to 1938, when we have a mid-year election year, historically, the first 3 quarters of the investment markets will have negative rate of return. Now, this year is an exception to that rule because we're having positive growth in the stock market so far. We still have another quarter to go before the midterm elections. But after midterm elections, you'll see that on average, equity returns have been pretty good following midterm elections. And we kind of think this is built into the market already because the margins between who's going to control the House and Senate are pretty razor thin. And that kind of produces a neutral government, which is generally speaking fairly good for the investment markets. So the other thing is we find that this is a constructive sign that the 5 themes that I've discussed are helping to support the market. So far, so good. We're in a good spot. And Brian Carlson from Summit, he's one of the partners. He's going to take us through the 3 engines for growth in 2026. So I'm going to go off screen share and turn the floor over to Brian.
Yeah, so thanks, Sean. So to reiterate kind of some of the themes that Sean just mentioned and just working off of these 3 engines of growth we see, and AI is certainly grabbing a lot of headlines positively and negatively, but we think for the economy, a lot of positives. There's a lot of spending, right? Not only by those AI companies, those are definite revenue generators as far as manufacturing, build out, chip build out here in the States. But what I think we're most excited about is number 3 here, the productivity gains. That's not just focused on just those technology companies, but businesses throughout the US. If someone in a manufacturing firm, an employee can accomplish instead of normally 20 tasks a day with the assistance of some AI software, if they can get 40 to 50 things done in a normal day, well, then that's a productivity gain for businesses. And we can see that kind of translate and grow throughout the economy, not just centered in just those technology companies that we're all hearing about every day. Builds into that second theme of an industrial renaissance. Semiconductors are a big part of technology, right? Not just AI, but in everyday life. We got it, of course, in our computers, our phones, but in our appliances, washing machines, cars, they're everywhere. So I've heard them referred to as the new oil, the new commodity. And I think there's a recognition of that here in the US, which leads to bullet point number 2 here, in that we recognize we need to have a manufacturing build out here and a renaissance here in the US. So these semiconductors are so important. We need to be able to produce them here domestically in the US so that we're not reliant on imports. And so we've seen, large examples of that, of Taiwan Semiconductor making large investments here in the US, Intel across the board to do that manufacturing. And that's a great thing for the general economy, for employment and things like that. Defense, for obvious reasons, we have the conflict with Iran going on, but across the globe, I think there's a recognition that countries need to spend more on their own defense. And so we're seeing that also in Europe, Germany really ramping up their spending in defense, which no matter how you look at it, translate into a manufacturing build out. And so a great manufacturing statistic that we recently got was we've seen new orders here in the US jump up by 20%, a 20% increase in what manufacturing firms are seeing as far as in the pipeline. So very positive sign generally for the economy there. On the fiscal side, Sean touched on the new tax bill. We've seen across the board, higher deductions for those seniors. Folks, the SALT cap was increased so that more folks can itemize, lower their tax bill. So some good things there for lower overall household tax burden on the consumer. And then from a business perspective, to assist this reshoring, this industrial build out here in the States, the new tax law allows for companies to do 100% immediate expensing, which just means they used to have to amortize or kind of spread their expenses out over 7 to 10 years. They can now build a factory and basically expense that cost all up front, which is a great boon and helps them really offset their costs. So that's a good thing. And then really, again, just that infrastructure and defense theme. So as Sean mentioned, we're certainly bullish as we move forward, but aware, right, cognizant that there certainly are some risks. And so we call it, I guess, a resilient growth atmosphere. So there are certainly some headwinds. I think the biggest one is we still haven't resolved the conflict in Iran. That's a very volatile situation, as we all know. So that one remains to be seen, which I think is tying into this third bullet point of we have a new Fed chair, as Sean mentioned. And yeah, we do think eventually they're going to cut rates, but they're kind of stuck in the middle in an area right now with the higher oil prices. That's kind of putting some pressure on inflation. And so they can't really ease right now. They just had a meeting where they said they're just going to hold rates. And we likely expect they hold for the next few meetings. And as we get hopefully some price decreases on the oil side, inflation pressures will decrease, will allow the Fed to cut rates, which as Sean mentioned would be a great thing. Certainly some concentration risk in the technology sector. So certainly, some things to be concerned about, and we're aware of those and cognizant of that. That's why we keep a diversified portfolio, as Sean mentioned. But on the flip side, some very positive tailwinds as well. Corporate earnings remain really resilient throughout the conflict, throughout the increase in oil and energy prices. That's been great. Consumer spending, you got to love the U.S. consumer, right? If we do one thing well, that's spend money. And U.S. consumers can continue to do that, even through these higher oil prices. That's a great thing for the economy. Again, the Tax Act's certainly helping. And defense spending. So all those things, as we bring more spending back domestically, are certainly good things for the U.S. economy. So this slide then kind of takes a more global look and kind of takes an analysis of where are we and where are various countries in the business cycle. And the business cycle is a very normal thing. We've gone through it hundreds of times in our country, right? Through an early cycle, as you're kind of emerging from a recession, to a mid cycle, which is really great growth and things are peaking and things are looking great, to a late growth cycle, which is also a good thing. And then as things slow down, eventually economies head to recession. And that's just, again, a normal part of the business cycle. We've done it several times in our country's history. And you can see a lot of our friends, in the Eurozone, Canada, Japan, and even India, Australia are positioned quite well, which bodes well for the overall global economy, which is a great thing. We obviously operate in a global economy. And you'll notice the US, I'll make a note, we're kind of solidly now in the mid-cycle growth, which is a great thing. But I will note about a year to 18 months ago, we were kind of positioned between right around where India and Australia were, sort of entering that late cycle, which is not a bad thing. It's just things, hey, we maybe are running through the end of this cycle, but we've actually moved backwards in a positive manner to be more in the mid cycle. And a lot of that has to do with this manufacturing and this reshoring really that we're seeing here. A lot of the spending that we're seeing from business spending and the consumer being a resilient spender. So definitely some positives across the globe, which is a great thing for the overall global economy. Now, certainly cognizant of the risks out there. And so history is a great lesson, right? It doesn't necessarily repeat, but it rhymes. And so as we look back from geopolitical shocks or events that we've had throughout history, all the way back to World War II, what this chart shows us is after that event or the war or whatever it was began, where was the market 1 year forward? Where was the S&P 500 1 year after this negative event in the geopolitical world? And so to the Cuban Missile Crisis, the Vietnam War, the Six-Day War in the Middle East, 1 year later, generally positive. And so throughout a lot of these events, the average historical 1 year after a negative geopolitical event is about 8% positive. Now we have some outliers here, right? 9/11, that was obviously the terrorist attack coupled with a tech bubble, right? And the biggest one I think that maybe ties to today is the oil embargo back in the late 70s, where we had oil prices skyrocket. Sounds familiar due to some conflict in the Mideast, right? It definitely hit us pretty hard as a country. But I will say that today is not the 1970s as far as energy prices go. Okay. This is definitely not the 1970s. And the biggest difference is the US is now the largest producer of oil in the world, the largest producer. And we've actually been a net exporter of petroleum since 2020. So we're a net exporter now. We produce more than we need so we can export some of our product to the rest of the world. It doesn't say that we don't feel the prices. We certainly have. But you can see this ramp up here in the production since the mid 2000s of US oil production, a function of many things, right? But generally a positive for the economy, which is to lead into this second chart here, which is just to say how much of our wallet share, how much do we spend on a normal day or normal basis, right, to fund our energy needs. And back in the late 70s, you can see this huge spike. And that was because we were so reliant on imports. We basically had very little to no domestic production. Definitely a change, where we were spending almost 13% of our overall budget just on energy back in the late 70s. That's about half of that at 6 to 7% today, even with the shock that we felt here. And anecdotally, I drove to Iowa to visit my father-in-law this past weekend, and it was great to be able to fill up at, 3.85 a gallon versus close to 5. So that felt good. So we're definitely seeing price of oil come down where the oil per barrel even a month ago was over 100. I see it today trading at about 70. And so we expect those price reductions to filter through to the pump, which will be a general, very positive thing for the overall consumer. That said, inflation remains sticky, right? The Fed kind of has what I think is a bit of an arbitrary target of 2%. We're a little bit above that right now, but I think that a lot of that is due to the higher oil prices. And so we should see that come back down more in line to the average, which then will free up the Fed. I think that's why they had to wait here recently. Kind of said, hey, we're going to wait on rates. We're not going to move up or down. We're just going to wait and see. And I think as prices at the pump start to come down, that will free up the Fed to start hopefully lowering interest rates as we move over the next few 3 to 6 months. So it would be a good thing for the overall market. One nice thing, Sean touched on this, we've seen very large refunds from a lot of our clients that get their tax returns done here in 2025. And we expect that to continue as the new tax bill really fully kicks in 2026. And so that kind of is acting as a cushion, if you will, from these higher oil prices. Folks have gotten a bigger refund or they owed a lot less come tax time. And so they've got a little more dry powder in the form of cash on hand so that we can, it's not fun to have these higher oil prices. I certainly agree with that, but we can absorb it a little bit. It acts as a little bit of a price shock as far as the higher prices at the pump, which again, we do expect to come down here now as we see oil prices moving below about $70 a barrel. So good things there. But through all of this noise and all of the, short-term noise, conflicts, where are we 12 months after the conflict, high oil, take your pick. At the end of the day, what drives stock prices is earnings, right? Are the companies earning money? Are they profitable? Are their earnings growing? Well, then the stock market's going to follow. And if not, the stock market will follow the other direction as well. And so this chart does a great job of illustrating this to the late 1980s. And we could take this all the way back to 1950. And the same rule would apply. Stock prices follow earnings. Ignore all the short-term noise. We talk to you guys about this all the time. Like, hey, don't worry about the headlines today or next week. What is going to drive the market over the long term, and we are long-term investors, is earnings. Okay. And you can see this in this light green bar here. Those are company earnings, the little boxier line. Those are the earnings of the S&P 500 companies since 1980. And you can see the general trend. And then that darker green line, definitely a little more active, right? That's the actual stock market. But the general trend is there. As earnings move up, stock market moves up. Earnings come down. Okay, we follow with the market. Same thing. Earnings move up. Not a perfect correlation, but certainly the general trend is absolutely there. So what drives the market? Sure, in the short term, maybe some headlines, but overall, over the long term, as long-term investors, it's earnings. Are companies making money? Yes, then the market will follow. Leads us to an obvious question: where are earnings heading? I'm sure everybody has that. Right now, we're seeing some great forecasts. This is in the US, but I will note we're seeing some great earnings growth overseas, specifically emerging markets and things like that, and countries that are really kind of leaning into some of this new technology to really drive efficiencies in their economies. And so Russell's going to touch on kind of our allocation, our models, but we're seeing some opportunities overseas as well, some interesting opportunities. But here we see in the US, we kind of separate this out. The Mag 7 is those big technology companies that we all hear about. But what I'd rather look at is just the S&P excluding those. Those are all the other companies that are out there. And where are their earnings growth heading? And for 2026, estimated growth 16%. Another solid teens growth in 2027 projected right now. And of course, technology is still growing, right? That's a great thing. So definitely earnings on track to continue to grow, which if we go back to the previous chart, if that continues, then we should expect, certainly not a smooth line, but that the market will continue to keep growing along with those company earnings. So I will stop there, and Scott's going to jump on here, and he's going to start talking about a little deeper dive into AI and some of the fixed income market stuff. So thanks, Scott. Go ahead and take it away.
All right. Thanks, Brian. So, building on what Brian and Sean have been covering, just wanted to talk a little bit more about the evolution of AI and then more specifically, well, why is it having such a big impact and having so much significant investment? And so it's a bit of an AI race, but to try to separate out the different types of AI and maybe define a few of these terms we keep hearing out there in the news, you have generative AI, agentic AI, and physical AI. And so, generative AI is probably what we're a little bit more familiar with. Generative AI is, you can kind of tell online if you're looking at images or scrolling on your phone, people use it to generate images or text. It is a great tool when it comes to translating language. So if you're traveling abroad, generative AI can help with that significantly. And then agentic AI is becoming more of a topic as of late as AI has improved a little bit. And what this would be more so is you could think of like an AI assistant. For example, you're booking a trip to Florida or Arizona or somewhere south for the winter, a travel agent, right? They could check prices and do different things like that for you to help you do that research, right? So you could put together kind of an AI assistant, and that would kind of be that agentic AI. And then physical AI, I think if we think about physical AI, it's been around for a little bit. The most obvious things out there have been autonomous cars, autonomous vehicles, smart manufacturing and logistics. In the factory, you see warehouses. There's a lot of physical AI in there already, and certainly improving with this new technology, able to work a little bit better. Just to define some of those terms, but this next slide here is talking about the hyperscaler investment. So just to try to bring this into perspective a little bit, we've talked about business investment helping with the economy, right? When businesses invest, that goes into economic activity, into our GDP number. So just in perspective, right? This is 5 businesses we're talking about. So Alphabet, we know as Google, Amazon, Meta, we tend to know as Facebook, Microsoft, and Oracle are the 5 hyperscalers. So if you type a question into ChatGPT, for example, they're running all of that back end hardware and data centers for that answer to come back to you. And there's a significant amount of investment. And as of today, why are they investing more? It's because they're having a lot of demand for the usage of their tool so far. So perspective-wise, in 25, those 5 companies alone spent $416 billion, which is a significant sum of money, and not quite doubling here in 2026, but that spending coming out to $740 billion for this year, expected to rise into next year. And so that's real economic spending that's going into GDP, and there's real jobs on the other side of all of that spending. So the picks and shovels at the end of the day are construction companies that are building the data centers, and of course all of the companies that sell the products that go into those data centers. So at the end of the day, it's hard to predict where AI will go. It's a new technology. I think back to my own life. If I looked at the mid-1990s, let's say like 98, I remember a few friends having cell phones, and then soon later on, everyone has a cell phone. And then I think now we have smartphones, of course. I would say in 2010 or so, not as common, and then nowadays very common. So technology is an ever-evolving situation, but today it is a big economic impact because of these 5 businesses and many others investing significantly in our economy, and lots of real jobs on the other side of all of that spending. This next chart here has to do with the strength of the dollar. I do tend to get a lot of questions about the strength of the dollar over the years, and this is kind of a nice chart here. This goes back to 1984. This tells us the strength of the US dollar versus emerging markets in blue, and then this green line tells us the strength of the dollar versus developed markets, so Europe and Japan. So we'll focus more on this dark green line here. You can see the dollar reached a significant high value back in 2000, declined into 2010, and then rose to a higher valuation, which we've been at here for the last 3 or 4 years. And so what's the big take home here? At the end of the day, it's not specifically a bad thing if the dollar weakens, right? It makes our exports more attractive. And so a weaker dollar can be a tailwind for returns in the markets. So if we just kind of focus off to the right here on this chart, this very dark green, average return 1988 to 2025 when the dollar is weakening, it's about 13% for the US market, right? Now, if the dollar is strengthening, US market tends to still do pretty well. And then looking at international markets in the center here, man, if the dollar is getting stronger, internationals really struggles. And that's really the environment we've been in for a very long time. Lots of concern, obviously, in international investments. I'm sure you've all noticed here and there. International hasn't performed too well. We're probably on average moving forward from here more in a declining dollar or falling dollar, considering we're at the high end of that valuation. And that tends to be a pretty good tailwind for international, right? So average return 88 to 2025. With a falling dollar, about 12.5%. So we're seeing some potential opportunity international. And then the other huge thing, and something you've probably heard over the years from us here at Summit, 3Ds, dividends, diversification, and discipline. Well, when we look international, the stock market looks different, right? And believe it or not, the US market today, nearly 35% of our stock market is information technology, right? And the S&P 500 has certainly been the global leader in stock performance for quite a long time. That is very significantly attributable to information technology. Technology companies have done extremely well, right? But when we look at a market that could be considered a little bit more expensive, diversification is always more important. And so when we look at this international market and say this dark green, for example, you're seeing much lower information technology. And what you're actually seeing is a significant amount of industrials. And so when we look to those international markets, we are buying different types of businesses as well. So not only do you have that potential dollar impact, but it is a huge diversifier when we look to international markets, which is important when looking at your total risk. We will wrap up a couple slides here and just talk a little bit more about bonds, fixed income. And if you were to look at this left chart, we're just going to cover this chart on this slide. And if you were to look at the total yield, right, the dividend on the US 10-year Treasury, this range has been all the way from a 0.2, 0.3%, that would have been 2020, for example, all the way up to just north of 5, right? So, for example, we are at the higher end of this scale, okay? And then this other chart is just the broad bond index, so including bonds from corporations, etc. We're at the higher end of this. Now, we've had a lot of questions on bonds and concern, rightfully so, on that bond market return. But I really want to take this time to kind of point out we're in a much different world today than we were, okay? And if we were to look at what our expected return in bonds were, they're better today than they've been in over 15 to 20 years, right? So if we look at this chart, in the 2020s, we had very low yield, very low interest. That's that very dark green. This orange is the entire 2010s, okay? Our expected yield, remember we were getting at the bank, our savings accounts paying us 0.02%, right? You get a couple pennies a month. But looking even at the bond market, our yield is in that 2-3% range. And then if we take it further, this green, well, that's the 2000s, right? We're going all the way back to the 2000s when we're thinking, hey, we could make a pretty decent return, maybe 4 to 5%. And this very dark green right here in the center is kind of where we sit as of May 29th. Current yield of about 4.67%. And in general, that would imply a forward 5-year return of near 5%. So where we're sitting today, here in the middle of 2026, yes, we've had some tough years behind us in bonds, but our outlook for that bond return is probably better than it's been in over 15 years. So bonds are very much still an important part of a portfolio, and we're looking at better potential returns that we've looked at since early 2000s. And then bonds, again, they tend to provide a balance against stock losses. If we're looking at this chart, these are all the years where the S&P 500 was down in dark green, and investment grade bonds is the return of bonds in that same year. Okay, so almost always outside of 2022, you are seeing that investment grade bonds are giving you a positive return, right? Even in 2008, a year that we probably all remember, you're seeing a very strong return. And then, of course, 2022 was the one challenge, and that's where we're seeing concern. But the way I think I would frame that 2022 is more of a great bond reset. It was a big surprise, and it was certainly not an enjoyable experience. You tend to have those types of things in markets, but we're sitting in a much better place here today. And with that, we're going to transfer over to Russell, and he's going to go through a little bit more information here.
All right. Thank you, Scott. Yeah. So what I want to talk about is what we've done to the portfolios so far this year in 2026. And what you're looking at is an S&P 500 chart. So year-to-date S&P 500 chart. Now, one of the powerful tools that we use in adjusting portfolios, of course, is a rebalance. And as many of you may know, when you rebalance a portfolio, you're getting back to those intended target percentages that you wanted and all the ingredients inside of that portfolio. If you have, let's say you have 10 funds in an account, in a portfolio, and over time, they're not going to all perform the same. Some are going to outperform, some are going to underperform. And many of our clients, of course, are taking monthly distributions, and we're sending those monthly distributions from high quality bonds. Remember that income bucket that we've spoke about? Sean talked about that in the beginning. Of course, we draw the buckets of money in our meetings to remind clients of how we distribute by taking from those lower risk assets. That's your near term liquidity. So when we do a rebalance, we're getting back to the targets. One. Two, we're also replenishing those income buckets. We're filling back up your bonds. And three, it's also an opportunity to adjust the allocation. And perhaps there's an area that you want more exposure, and maybe you want to reduce exposure in another area. Okay. And then lastly, changes to the portfolio, doing a rebalance. There may come a time where there's a fund that might be underperforming. And so we're looking for the same exposure, but the particular investment vehicle that we're using, the particular fund we're using, maybe is not performing very well. And so we need to replace it with something that we think is going to do better. So now on this chart leading up to this, so this is starting in January 2026. Now the prior calendar year, the 2025 calendar year, the context is the S&P 500 went up 17.8%. Okay. And so now we've kind of plateaued as we're coming into 2026. And this green arrow represents the first adjustment that we made to the portfolio. Now, February 17th, that was a full rebalance across all of our models. And one of the things that we did was we increased exposure to international equity. Just as you've heard from Scott and also Brian touched on it, some opportunities in international. So we did increase that a little bit. Now, overall, we're probably still underweight in international equity in the big scheme of things compared to baseline. We've been underweight in international equity for a long time, probably since I started working here in 2011. So it's about 15 years. And that rewarded portfolios with better returns because US stock market has handily outperformed, generally speaking. Now that's long term. But now Scott was talking about the dollar. Okay. And so opportunities looking a little bit better. So we had a little bit of increase there. All right. Now, this is not on the chart, but the second change that we made was on April 9th. And what we did was a security swap. So we had a particular fund. It was a large cap growth fund, and it was underperforming. And so we swapped that out. We actually replaced that fund 50-50. We split it between two funds. So that occurred on April 9th. And then lastly, you can see this dip here. This is the Iran war dip. And look at that green arrow on June 2nd right there. Now this is, boy, we try hard. We love to do a rebalance when the market's high. This is a happy coincidence, of course. But that was basically the highest the S&P has been ever, about 7,600 points. So June 2nd, again, we did a full rebalance. We sold those stocks at high prices. We trimmed some of those gains. We added to high quality bonds, filled up the income bucket. And one other change, one of our sleeves, we had a large cap value fund, and we became aware that this fund was likely going to close to new investors. Well, that's a problem if it's in your model portfolios, if you can't add new money to it. So we actually went to the same company and we found a very good replacement, a very similar fund, which is an ETF rather than a mutual fund. So we made that adjustment when we did the rebalance on June 2nd. So those are the changes that I wanted to highlight. And at this point, I'm going to hand it back over to Samantha, and then I think we're going to get into some Q&A.
Okay, excellent job, Russell. Thank you, Brian. Great job. Same for you, Scott. Samantha, thank you again for putting the webinar together, the invites, the Q&A, and so forth. That concludes our presentation. If you want to hang out for a few minutes, we're going to go through some of the questions that we received in the Q&A area. So yeah, let's get to some of those questions. The first couple of questions that came in, Scott, you want to address those, please?
Yeah, so it's one of the questions that we tend to also get quite frequently is kind of on the Social Security outlook. And this has certainly been a big piece of the news. And so the specific question was, I heard there is a 24% reduction in Social Security coming, potentially early 2030s. So I think the big take home here, and you'll even see there's been information on your Social Security statements on this over the years, but if you were to look at all of the revenue that's coming in from Social Security, there's enough income from the tax revenue to cover about 80% of all of the current payments going out. Okay, so where do they currently make up the difference? And that difference is coming from the Social Security Trust Fund. And that is what they're talking about as running down. Now, I certainly don't know what will happen here, but I know for a fact that it certainly does have to be addressed. I generally believe what's politically possible, right? And I tend to believe that when it comes down to it, Congress will probably work to extend those Social Security payments as they have been. Now, in the past, we can look to when they did make changes, which has been quite a long time. When they did make changes to Social Security obligations, they made it for people who were not collecting and were pretty far away from collecting those benefits. So I see that as a more likely change, but I don't think anybody's going to be very happy if they saw a 20% decline in their Social Security, and they'll vote accordingly. They'll try to, they wouldn't be happy if it went the wrong way, is what I would say. So that is something that's out there, but we'll certainly see our Congress and administrations look at in the future.
The next question is, how can we take advantage of recent IPO of Elon Musk? That would be SpaceX stock. That's pretty simple. Just call your favorite investment advisory company, Summit Investment Advisors, and we could buy that stock for you in your account, or you could take advantage of it in other index funds that might own some shares of it. The next question is, to what extent does increase in AI productivity translate to job loss, especially entry-level or low-wage positions?
I think we're still early in that game. Certainly, we will likely see some of that translate. But again, as I touched on in the beginning, I think we see it more right now as a tool to increase productivity. Certainly been some layoffs in the tech area, and I think they may be regretting that. I heard that there were some large layoffs at Meta, and then they eventually had to repost a bunch of positions because they realized, hey, this isn't as far along as we thought. So likely see some of that. Scott touched on this well. Historically, there's always been technological disruptions, whether it was, the train lines or things like that. And I think I read a stat from the 1960s that almost 65 to 70% of the jobs that we had as an economy in the 1960s are now gone. They're now obsolete. But the unemployment rate has certainly done nothing but get stronger and better over time. And think back to when you got on the elevator in the 1960s that would push the button to the floor that you wanted to go to. We don't do that anymore, right? But we've evolved. Same thing with, I don't even know what you call it, the telephone switchboard operator. When you'd call and they would, plug in the different things in the 60s. That was a big job, but we've evolved. And so I think that's where we see the technology going, is helping the economy evolve.
Jack asked, do you think the U.S.-Iran deal already priced into the stock market?
Good question there, Jack. I certainly see there's some optimism that we're on the other side of an agreement that still has a lot of particulars to be worked out. But you have seen a strong decline in crude oil, right? It went from 100 down to 70. Gas prices went down a little bit. But I think it's going to be a little slower going than immediate. And so I think what we're working off today is that the tax bill has offset some of those higher pressures from oil prices. And I think that moving forward, it's probably not going to be very straightforward, but on average, the oil coming out of the Strait of Hormuz will continue to increase with fits and starts, I guess you could say. We're all aware of how many times they had a deal, but not quite yet. So I think that'll probably continue a little bit through the end of the year. And then it just comes down to earnings, right? Do businesses do well? Do they continue to grow their earnings? And I think that that's what's going to be key through the rest of the year. And whether that's priced into the market or not, I'm not 100% sure. But market will be happier with more global stability one way or another.
Okay, awesome. That concludes the questions that we have coming in. And once again, thank you for participating in our webinar today. Feel free to reach out to us anytime. And if you have any friends or family or people you'd like to refer our direction, we always appreciate that. With that, thank you again for joining and have a great week.